You know that feeling when someone shows up for you just when you need it most? That's what Uber is all about. Not just a ride or dinner at your door. It's how Uber helps you show up for the moments that matter. Because showing up can turn a tough day around or make a good one even better. Whatever it is, big or small, Uber is on the way. So you can be on yours. Uber, on our way.
Reality radio for a really great future. We're talking real money.
Well, one of our favorite things to do on our Talking Real Money podcast is to answer your questions. We like doing that, and we do it a lot of different ways. On our regular podcast, Tom reads questions that you have sent in at talkingrealmoney.com. You typed them in the old-fashioned way. We also take old-fashioned phone calls during our Saturday show at 855-935-TALK, which is 8255. We have a Saturday show that we do in Seattle, and you can call us there at 855-935-TALK between the hours of 3 and 5 Eastern Time on Saturdays. So there's that. Then there's the third. That's this edition. This is the typically Friday edition of the podcast. Most of these are me answering questions that you've sent in a way, from talkingrealmoney.com. Except this time, you go to the contact form and you hit a button that looks like a microphone, and you record your question using your computer mic or your phone mic or your tablet mic or whatever mic you have hooked up, because, well, it's not just old-fashioned phones. not even rotary dial phones. I mean, just old-fashioned ones, even old-fashioned wireless phones. It's now different. Things are changing. We're also working on and just about to bring out a special show every week or so where we invite you to join us live during the week and record a podcast and allow an audience to attend, and you can ask questions there. See, so we want questions all over the place. So send your questions in, and they'll get answered somewhere. And if you listen to the podcast every day, you're pretty much going to hear them. So let's get to today's questions, shall we? Here's our first one.
Hey, Don, this is Mark, and I just wanted to thank you and Tom so much, because you guys are the one can't miss podcast that I listen to. And after listening to you for 5 years, you guys have given me the guts to DIY this investment thing. So I really appreciate your straightforward and actionable advice. So we have about $20,000 we won't touch for 2 to 3 years. And right now it's sitting at Fidelity in the money market account, SPAXX. And I don't know the yield for that, or if you thought maybe I should put it into VTEB, and I thought that might be a higher yield for that money. And I was just wondering what your thoughts were. I think the yield differences are going to be great enough that I'm not splitting hairs. And I was just wondering if you thought go ahead and get it out of SPAXX and put it into VTEB, which is Vanguard, but Fidelity allows you to purchase. Thank you so much for everything you do.
Yeah, they allow you to purchase it because it's a ETF. It trades like a stock. And you're welcome, and thank you for the nice comments. This is not a fair compare. The money market is pretty much, their securities are almost daily liquidity. So you have liquidity, a duration of days, maybe weeks. So the portfolio is going to be constantly changing with the money market fund, with the SPAXX, SPAXX. Not so with VTEB, which is a Vanguard municipal bond fund. It has long maturities in it. Its average duration is about 7 years, which means you can have a high degree of volatility in the price. The price of SPAXX will not ever change. I mean, okay, could, but it won't because it's federal too. VTEB, in 2022, it lost 8% of its value. Money market can basically lose nothing. A bond fund, it can lose money. And it can lose money conceivably even over a couple of years, which is your time frame. If this is money you have to use in the not-too-distant future, you want to stick with the money market. Yeah, VTEB will likely yield you more. Its tax-free, federally tax-free yield is just under 4%, whereas the money market is just under 4.5%. So in most tax brackets, the municipal bond fund is going to be better, but it's better because it's riskier in many, many ways. Credit quality and maturities. So it's not a reasonable comparison. They're not the same kind of products. You keep your liquid money I believe you should keep it in a very liquid account that doesn't fluctuate much unless you have a very strong stomach. And it's like, okay, I don't need it in 2. I could wait 3. I could wait 4 if need be. I'm not going to freak out if interest rates go way up and the value of my bonds go way down, because that's what the risk is. If interest rates rise precipitously, the value of your bonds will fall. It's going to. There's no way around it. Thanks for the question and all the nice thoughts, and let's grab the next one that came in at talkingrealmoney.com and was spoken on the contact form.
Hi, Don. This is Rob from Colorado. My question today is about retirees and their cash on hand. I've heard you mention having 12 to 18 months of cash for emergencies or for market downturns, and I've kind of confuses me a little bit. What signal would I see to use cash from a market downturn? Is that like when your portfolio value drops 10% from a 52-week high, or even maybe 15% drop in 6 months? And would I use the same signal when the market recovers to stop using cash and to start withdrawing funds from the portfolio? Hope this makes sense, and look forward to hearing from you. Thank you.
Well, it's not that complicated. There's no need to look for a signal. There are 2 reasons to have cash, particularly in retirement. And I'll give you a couple of scenarios. Here's scenario number 1. I take out my annual expected expenses at the beginning of the year from my accounts as part of my rebalancing and moving things around. Or, another example, I'm taking flexible distributions. I plan to take 5% of the portfolio value every year, whether it's up or down. So at the beginning of the year, I take out, or at the end of the last year, I take out $50,000 from my $1 million portfolio. That's my spending money for the next year. That is my limit. Now, emergencies can happen. You find that you have an unexpected medical expense. You have a funeral you weren't expecting. A car breaks down and you want to buy a new one. Then over and above that year's worth of expenses, you have your emergency money. That's your 6 months, maybe even another year's worth of money. It depends on you and how much flexibility you want to have so that you don't have to touch your portfolio in case of emergency. 6 months is probably adequate. You keep that, and that just sits there. You don't use it. You don't use that part at all. That's only there for something unexpected, a big expense that is going to hurt you if you have to take it out of your investment portfolio. So there are like 2 cash pools. There's the living on cash pool, and you just literally live on that for the year. And then there's the emergency cash pool. That's there for a big surprise expense. But you don't kind of switch back and forth to living off your portfolio and then living off your emergency money. No, the emergency money's different. It's there for literally emergencies. Thanks for the call or the question. It's hard to know what to call these things. Thanks for speaking on the internet. And we still have a couple more left. In fact, I think we have 3 today. So let me grab another one right here.
Hello, Tom and Don. My name is John. I'm calling from Bucks County, Pennsylvania. Been listening to your show for quite a while, and I enjoy your balance between comedy and seriousness. My question is regarding Cliffwater Corporation Lending Fund. This is something that an advisor I have been considering using, who claims to be a fiduciary, is suggesting to me. He is suggesting this investment in the conservative bond side of my portfolio as a alternative to bonds. The fund is CCLFX, and it is private lending, which is growing like crazy and makes me a little nervous. Could you give me your opinion, please? Thank you.
Well, I would definitely not consider this advisor. I think advisors like this, in their zeal to make themselves look like they're smarter and better capable of making you money than the rest of the world, get into these oddball things, and I think Cliffwater is one of those things. It's like these private lending products, these non-publicly traded ones, except this one's publicly traded. But it's publicly traded with a lot of opacity. They lend money to companies that have a hard time borrowing money anywhere else. And that generally means lots of risk. And you know our philosophy, if you've listened, if a yield is high, it's high for a reason. It's high because the risks are high. Now, they're going to somehow make you believe that this is a non-correlating asset, so it's going to reduce your overall volatility. But there's not a great deal of evidence that shows that to be the case, particularly when you don't know much about the product you're getting into. And this is one of those products. Now, one thing I could find the price of the shares. Over the past 3+ years, the shares have fluctuated between $10 and $10.72. So it's not a capital gains generator. The big draw is the yield, which has run around 10% per year. Now, that's a heck of a yield. It is. It's a heck of a yield. It's more than twice the Treasury yield. Now, why would you get more than twice the Treasury yield? Can't be a safe investment, can it? Why would anyone pay 10% on money when they could maybe, if they're a good company, pay 7 in the corporate market or 6, something. Oh, wait, I forgot to add something. There's another little drag on returns that we forget to talk about. A bond fund like the Vanguard Bond Index has an expense ratio of I believe it's 0.03% per year. 0.03% per year. This fund has current expenses, total fees and expenses of over 3.5% per year. That's the management fee, the acquisition fees, the other expenses, interest payments on the borrowed funds because they borrow money. It's got to pay interest. All of that. And so now the underlying investments need to yield over 13% gross to the fund for it to pay you 10, right? Simple math. It's all so simple, and yet advisors like the one you're working with do their best to make it confusing. A fund like Cliffwater goes out of its way to make things less than clear. They are clear as mud about what they own and what they charge. They don't just put it right out front and make it really easy for you to find. No, it's tough to know. I bet your advisor never said, well, the total expenses are 3.61% per year, compared with Vanguard's bond fund at 0.03%. The Bridgewater fund is over 1,000 times more expensive. 1,000 times! Think about that. It's just... I would I wouldn't talk to this advisor again ever. I think this is just terrible advice. And they claim to be a fiduciary, but I'm telling you, when these things, and some of these things are gonna unravel someday, if the economy gets really bad, a lot of these companies that they're lending to are going to go out of business. And if they do, when they do, some of them will, this fiduciary advice isn't going to look so in your best interests at that point, is it? Fiduciary advice means giving people advice that's truly in their best interest. And do you feel it's in your best interest to be to be put into a product that has risk that is almost impossible to define, that has fees that are 1,000 times higher than a boring bond ETF? Does that sound like a fiduciary? I know they think they are, and they're not selling commissioned products, but doesn't sound like it's in your best interest. Let's take another question, shall we? This one came in at talkingrealmoney.com on the contact form. You can also call us, though, on Saturdays at 855-935-TALK from 3 to 5 Eastern Time Saturday. Here's the next one.
Hi, Don. My question is about Vanguard's actively managed funds. After reading about Bogle and Vanguard, I've came across a number of Vanguard actively managed funds, which appear to have mostly beaten the S&P 500 over the past few decades. My question is, with the constant emphasis on a globally diversified portfolio with index-based funds, what place does a PrimeCap or Windsor or Wellington have in a portfolio? And if it doesn't belong, then who are these funds meant for? Thank you.
Well, the active funds still exist because, well, active funds were all we had up until index funds in the 1970s. But they also exist because of people's belief that smart people can make you more money. They're just going to make better selections. Turns out the evidence doesn't support that. There are, by the way, many, many actively managed funds that have, past tense, beaten their index or their benchmark. Lots of them in the double digits percentages. The shorter the time frame, the more likely a managed fund has been to beat the market. The longer the time frame, the closer they get to each other, and that's really evident. Let's take a fund like PrimeCap. PrimeCap is generally a U.S. stock fund. They do have some international equities, but it's a very small portfolio. It's 170 stocks, something like that. PrimeCap's been around for a long time. VTI, the Vanguard Total Index, U.S. Index, has been around for a while. They both have 15-year track records, and they both come in at just over 13% per year on average over 15 years. So the returns are similar. The difference is you're getting a multi-thousand stock portfolio with VTI versus a almost couple of hundred stock portfolio with PrimeCap. And the other big difference is the fees. VTI has an expense ratio of 0.03%. PrimeCap has an expense ratio that, while low in the active arena, because it's Vanguard, is 10 times higher, 0.3. So can they beat them? Possibly. Is it likely? No, it's not. And if it's not likely, why wouldn't you want the greater diversification? Because even in a portfolio with, a couple hundred stocks, one stock going out of business, them being wrong about a stock and it going out of business, can can have a permanent impact. One stock out of 4,000. Yeah, what kind of impact is that? And again, given the statistical evidence, and it is overwhelming, anecdotally, there are a lot of funds that beat their benchmarks. There really are. Have beaten their benchmarks. There is also tremendous evidence that those who have beaten their benchmark in the past have been less likely to do so in the future. So you pick the best, but then they're not anymore. How are you going to know which ones are going to be the best in the future? You can't know that. So instead of trying to be above average, why not just pay less and accept average? Because average has been good enough for most of us anyway, unless we're greedy. I don't see any reason for it. And again, it's a legacy product. Remember, the active management was Vanguard's only claim to fame when they were like Wellington and Windsor and those kinds of products. Their indexes now are the bulk of their biz because evidence. Call us on Saturdays if you have a question. Our number is 855-935-TALK, or go ahead and send your questions in. You can type them or speak them at talkingrealmoney.com. And here's our last spoken question for this episode.
Hi, Tom and Don. I've only heard you recommend BND or BND and BNDX funds for what bond funds to hold in a simplified portfolio. I'm interested in your opinion on inflation-protected bond funds, or TIPS. Currently, my bond fund mix, mostly my IRAs, is comprised of about 50% of inflation-protected bonds. Would you recommend I exchange these for total bond funds instead? Thanks in advance, and I really appreciate all the sound advice on your show.
Well, thank you very much. We try on the show to keep things incredibly simple because we don't want to be handing people suggestions of 10 fund or 12 fund portfolios, saying, well, you need to get large cap growth, large cap value, small cap growth, small cap value, international developed markets growth, international developed markets value, emerging markets, real estate, international bond fund, U.S. bond fund, and a TIPS fund. It just starts to get really confusing for folks. So we keep it simple because it's good enough. Simple is good enough for the vast majority of investors. At least, those getting started, particularly those. But there does come a time when you want a more complex portfolio, possibly. And in that case, I think inflation-protected securities have a place in a portfolio. I don't think they have as large a place as you've given them because we tend to forget that a big part of our portfolio, if it's properly allocated, is already heavily inflation protected, and that's the stock portion. Because businesses can raise their prices in reaction to inflation. Bonds can't raise their yield unless they're an inflation protected bond. So they offset some of the downside of bonds in an inflationary environment, but their addition isn't as great as you might think in a well-diversified equity and bond portfolio because equities have that inflation protection feature kind of just built into the product. So should you have them? Maybe, maybe not. Is it okay that you currently have them? Sure. Should you have that much of your fixed income in TIPS? I wouldn't. I mean, I have a small portion in inflation protected, but not half of my fixed income. Not a terrible thing, though. It's not dangerous. It's not dangerous. In a non-inflationary environment, which who knows, in a deflationary environment, your TIPS funds are going to behave horribly, whereas your regular bond fund's going to do a lot better, or it should be. It has in the past. So there's another side to that coin. The fact that we've seen inflation so much in our lifetime doesn't mean anything. In our grandparents' lifetime, they saw deflation, and it was pretty horrific. And if TIPS had existed back then, they would have been bad investments. Thank you for the call. Thank you all for the questions. I'm still going to call them calls. I'm sorry. I can't help it. I'm an old talk show host. I'm old, and I was a talk show host, and I'm still a talk show host. I've been a talk show host for a long time. 2025? Yeah, it's been exactly 40 years. This is my 40th anniversary year of being a talk show host. I started out in Colorado Springs as a talk show host on a AM radio station and was just doing general kind of local political news talk. And 1988 went on to start doing financial talk. which I've done ever since. Thanks for being here. Thanks for being there. Thanks for listening in. Thanks for telling your friends. Thanks for participating. Thanks for liking us. Thanks for the nice reviews that most of you leave, except for you grumpy people. Thanks for telling your friends and neighbors and helping make us a consistently top 100 investing podcast in the country with really, really impressive audience numbers. Thank you, thank you, thank you. It makes me feel so good. And please keep doing all of those things. And go to talkingrealmoney.com and leave us a question or check some of the other stuff out. Also, check back there once in a while. We'll have invitations in the not-too-distant future to additional live podcast creation events where you can, quote, call in. You basically can ask questions on that live podcast recording, live podcast presentation. Yeah, we'll be recording it too, so whatever. Thanks again. Take good care of yourselves. And remember, almost every day except weekends and holidays. Well, we are on weekends doing a show. We're here almost all the time talking real money.
The opinions and views expressed in this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions.
Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy.
Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor.
Please see Appella Wealth's ADV Part 2A on our website for information regarding Appella's fees and services.
Appella Capital, LLC, DBA Appella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. I think I need a nap.